Every entrepreneur, Walter, faces this kind of question at some point. Should I go and look for debt to increase the capital in my business or look for an investor to fund my business's growth plans?
So let's define those things. So debt financing, you're borrowing money. You could be borrowing it from a bank. You could be borrowing it from a person, but it's a loan. And one of the pros of that is you retain full ownership of the business. You retain control over the business. The interest on that loan is usually tax deductible, and it provides a lot of predictability around repayment of that. There's usually a set period over which you repay that, and that provides a lot of predictability. The cons are debt increases the amount of cash that needs to come out. So if cash flow gets tight, the lenders are not likely to be forgiven and it will starve other resources. And some loans come with very strict repayment schedules. As a matter of thumb, I would say that the more desperate a business owner is to borrow money, the tighter and stricter the repayment schedules are going to be, and probably the higher the interest rate is going to be. Now, there's the other side, which is equity financing. In equity financing, you're raising money by selling a portion of the equity in your business. You are literally selling shares of your business. And this would include venture capital firms, angel investors, crowdfunding, private equity. And one of the pros of this is there's usually no repayment obligations. And you may attract investors who bring particular kind of expertise for your business. They may bring valuable connections. They may bring valuable resources, valuable introductions. Now, the cons are that you're going to give up some portion of ownership and some portion of decision-making control. And there's a potential conflicting interests with the investors. The investors may want to recoup their investment sooner rather than later, and that may conflict with your operational desires.
So, Walter, it sounds like that there were a few major sectors that had main differences between debt and equity financing. If you were to summarize those and kind of compare each, what would those main areas be?
Well, in debt, you maintain complete control of the business, but you are beholden to repayment terms that are often can be unforgiving and very strict. With equity, you gain control, you gain partners, but you have to share decision making. So you have flexibility often about repayment, and sometimes you don't even have to. It's not expected to be repaid, but you're giving up control of the business. Debt has usually a higher risk, especially if revenue is uncertain or is going to fluctuate. And the equity financing is the risk of relationships. The risk is that you're going to create a contractual obligation for someone that you turn out to not be able to work with. In terms of cost, debt financing, the interest payments are usually a very predictable cost. As we said earlier, they're a tax deductible cost. So there's a nice predictability and utility to that kind of expense. Equity financing, it can be more costly in the long term for two reasons. One, your investors may be expecting a higher dollar return than a bank would expect on their money. And then two, the amount of control that you have to give up to acquire the equity financing may be unpalatable down the road.
So it sounds like that it's a pretty big decision, and there's lots of different factors to weigh in. What would you say that business owner needs to think about before diving into one or the other?
Number one, what's the health of the business? Do you have consistent cash flow to handle debt repayments? If cash flow is pretty consistent and you have a nice track record of even slow to moderate growth, then I would consider debt financing to handle that. Also, define your goals. Sometimes businesses, in order to achieve some kind of strategic objective, they need quick capital and they need it fast, or are they looking for longer term strategic support? Again, investors often bring more than just money. They often bring wisdom, experience, relationships, connections. That's not part of what's involved in a bank loaning you money. And then the last, I think, is risk tolerance. How comfortable are you with the financial obligations versus sharing the decision making and the ownership in the business? One of the things that you're going to need to figure is, where are you in your growth phase? If you're early in the stage of your business, you may not even qualify for loans, and you may be very attractive to investors based on the particular widget or flavor of secret sauce that you manufacture, but banks may not be willing to give you the time of day. Stage of your business, your risk tolerance, these are all factors that are going going to go into the equation of how are you going to acquire capital.
So it sounds like regardless of whatever option you take, making sure that you have a good picture on what is the actual financial health of your organization, the cash flow forecasted for the organization, whether it be to satisfy debt obligations or to present in front of potential investors that are looking to be able to put in equity, and just considering what either option could be impacting in the future of your business will be important consideration. And we love helping clients be able to get the clarity and confidence in their own business and what these opportunities can open up before going and making a big decision. So, Walter, what are some closing thoughts that you could think of when people are arriving at this kind of choice?
You make me realize that for many business owners, the accuracy of the financial statements, this may be the first time someone outside of the business really cares about your numbers. They are definitely going to want those numbers to be accurate, and they're going to be pretty upset if they're not, and they find out later. While you may be able to tolerate inaccurate numbers or fuzzy numbers, your banker, your lender will not tolerate. That's not going to fly, and is going to get in the way of you acquiring capital, either through debt or equity. And the other thing I think I would say is it's really important that the business owner understand where they're going in the short term and the long term, because the short term goals may dictate one kind of financing and the longer term goals may dictate another kind of financing. And so you want to measure those two against each other and come to some agreement about which is right for right now.
Yeah, it's definitely not a one size fits all situation. And if you're weighing your options about what this looks like and you want another voice in the conversation, then let's talk about this together. We want to help you make this decision to be as smooth and as stress-free as possible and make sure that it's the right one for your business. So let us know how it can help.